The market is currently closed, and Nuburu trades under the ticker symbol BURUR on the NYSE American. As of the final closing bell on May 18, 2026 at 4 p.m. Eastern Time, Nuburu equity settled at exactly 0.1894 cents per share, marking a downward intraday move of 7.16% during the standard session. This microcap equity has been navigating an incredibly turbulent environment, but what the broader public missed while watching this single session slide is a major fundamental reorganization happening behind the scenes. Just days ago, on May 14th, management dropped an unexpected financial update, revealing a dramatic $18.4 million improvement in preliminary, unaudited stockholders' equity for the first quarter. While casual market participants see a sub-dollar penny stock sliding towards its 52-week lows, savvy institutional eyes are focused on whether this sudden balance sheet turnaround will successfully rescue the enterprise from getting delisted by NYSE regulators. The prevailing market consensus paints Nuburu as an incredibly high-risk, speculative microcap tech firm bleeding cash and struggling to keep its head above water. Most retail traders looking at this space assume that a company trading for less than 20 cents is inevitably heading towards a total wipeout or a massive reverse split just to survive. However, the reality hidden underneath the surface challenges this simplistic bearish view. Nuburu is actively shifting its entire corporate identity away from a pure-play commercial industrial laser manufacturer and converting itself into a dual-use defense and security infrastructure platform. By integrating advanced blue laser systems with directed energy technologies, non-kinetic defense solutions, and electronic warfare software, they are positioning themselves directly in front of massive government budgets. The common assumption is that the business has run out of rope, but the contrarian reality suggests that a restructuring of their debt and equity mix might be laying the groundwork for a highly targeted tactical rebound. Analyzing the daily and weekly price action reveals the intense tension governing this asset. With a 52-week high sitting at $4.24 and a 52-week low dipping to 0.15 cents, the recent compression down to the 0.18 level highlights severe institutional and retail exhaustion. Trading volumes have spiked sporadically, often driven by momentum algorithmic platforms rather than long-term capital commitment. This capital volatility is precisely why platforms like Robinhood, with its access to fractional shares and immediate retail liquidity, see heavy speculative volume on microcap names like this. Traders utilize the Robinhood mobile app and its cash management features to swing trade these low-priced equities, but the real structural story is being told through the company's exchange compliance battles. On May 12, 2026, the NYSE American issued a subsequent non-compliance notice because the company historically carried a massive stockholders deficit of $15.2 million at the end of December. The market immediately reacted with selling pressure, pushing the asset down towards the lower boundaries of its trading range, yet the massive volume failed to trigger a complete capitulation below the absolute floor. This brings us to the core financial struggle that is dictating every single tick of the ticker right now. To maintain an active listing on the NYSE American, an individual brokerage holding shares for clients must monitor whether the underlying asset meets minimum equity thresholds. Nuburu was required to clear a $2 million hurdle, which looked almost impossible given their massive historical deficits. But the mid-May preliminary report blindsided short sellers by projecting a positive stockholders' equity of approximately $3.2 million as of late March. Management is pushing hard to clear the higher $4 million compliance threshold by the time they file their upcoming quarterly report in June. For anyone practicing self-investing or navigating online investing platforms like SoFi Invest or Interactive Brokers, understanding these structural accounting thresholds is vital. If Nuburu fails to cross that $4 million mark, the exchange could initiate delisting proceedings, which completely alters the liquidity profile of the common stock and forces institutional funds to dump their positions regardless of the technology's underlying value. Let us step back and look at the actual machine driving this corporate engine. Nuburu founded its business model on a very specific scientific breakthrough, commercializing blue laser technology. Standard industrial lasers rely heavily on infrared wavelengths, which are poorly absorbed by highly reflective metals like copper, gold, and aluminum. Nuburu solved this physical limitation by building high-power blue lasers that transfer energy with extreme efficiency, drastically speeding up welding and additive manufacturing processes for electric vehicle batteries, aerospace components, and consumer electronics. But commercial industrial adoption is slow and highly cyclical. Recognizing this bottleneck, the company initiated a pivot into directed energy weapons and counter-drone defense. They formed a joint venture with Maddox Defense to construct a funded prototype called the Mobile Additive Manufacturing Container, designed to build drones and specialized components directly in the field for military operations. They also expanded a binding agreement to acquire a majority stake in Tecne, an Italian electronic warfare firm, which grants them entry into the European defense sector, assuming they clear Italy's rigorous regulatory framework. This operational shift entirely alters how an investor utilizing online investing sites or a premium platform like Fidelity Wealth Management must evaluate the asset. On one hand, you have an enterprise operating with a going concern qualification in its annual filings, meaning there is a definitive structural risk that the business could run out of operational cash if its capital pipeline dries up. On the other hand, they're staring down a combined defense and software sales pipeline valued at over $6 million, backed by an initial counter-unmanned aerial vehicle deployment order. The operational reality is a race against the clock. Can they convert this commercial pipeline into actual cash flow before their remaining capital reserves are entirely exhausted? This structural tension is exactly why high-risk microcaps are completely excluded from algorithmic automated strategies like Schwab Intelligent Portfolios, which favor stable, blue-chip diversification. For an individual managing a self-directed portfolio on an interactive broker's platform, an asset like this represents a binary bet on government contract execution and regulatory survival. When you look at the macro picture, the entire defense tech sector is experiencing a massive influx of capital due to escalating global tensions and the clear effectiveness of drone warfare in modern conflicts. This has driven immense retail interest across top investing sites, with traders hunting for the next microcap defense stock that could catch a massive government tailwind. Comment below how many shares of Nuburu you currently hold, or if you think the defense sector is getting too crowded for small firms to compete effectively. While mega-cap tech giants command the headlines on daily financial networks, these nano-cap defense plays operate in an entirely different financial ecosystem, where a single $10 million government contract can completely transform the underlying valuation of the equity overnight. Yet the persistent short interest and the technical sell signals flashing across moving average indicators demonstrate that institutional short sellers remain highly skeptical of the company's ability to execute without inflicting further dilution on common shareholders. Looking forward, the roadmap for Nuburu is defined by distinct near-term catalysts that will either validate the current corporate turnaround or force a major capital restructuring. The primary milestone is the official confirmation of their first quarter balance sheet figures in the upcoming formal filing. If the audited data matches the preliminary $3.2 million equity projection, it proves the management team successfully wiped out a crippling liabilities deficit through their recent post-year refinancing and restructuring efforts. The second major catalyst is securing authorization under Italy's strict regulatory frameworks for the Tecne acquisition, which would instantly expand their international operational footprint. However, investors must remain clear-eyed about the structural risks. The company recently filed documentation allowing for potential equity sales to raise capital, a mechanism that provides necessary liquidity but inherently risks diluting existing stakeholders if executed at these depressed sub-dollar prices. To properly frame this asset, one must balance the stark divergence between market expectations and corporate reality. The market expects a distressed minor tech company to slowly fade away under the weight of strict exchange requirements and persistent historical net losses. The emerging reality, however, reveals an agile dual-use defense developer that managed to engineer an $18.4 million balance sheet improvement in a single quarter while aggressively targeting a massive counter-drone market. Whether you analyze equities through advanced trading infrastructure or monitor your positions via casual retail applications, this stock exemplifies the extreme volatility of speculative defense tech. The central question is no longer about the physical viability of their blue laser technology, but rather the operational efficiency of their corporate turnaround strategy. If the upcoming quarterly filings confirm compliance and validate their defense pipeline, the business will have successfully rewritten its financial foundation. But until those filings are stamped and verified, the equity remains a battleground of intense speculation. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends. Subscribe for more updates.